Welcome to the second episode of Dividend Investing Insights, your go to source for all things dividend investing. Whether you are a seasoned investor or just getting started, our channel provides insightful analysis, expert tips, and the latest news to help you build a reliable income stream through dividends. Join us as we explore techniques to maximize your investment returns. Subscribe now and take control of your financial future with the power of dividends. A quick recap for the week. The share markets had a tough time last week with S&P 500 falling 2.1% and Nasdaq falling 3.4%. At the same time here in Australia, ASX 200 gained a marginal 0.28%. However, as a dividend investor, we should not be alarmed by these movements. Share prices go up and down all the time. And you, as an investor, should focus on companies that have the ability to pay consistent dividend in the current year and the years to come. In the first episode last week, we had looked at a dividend investing checklist. This week, we look at the next important step in the share selection process. Today, we will look at if the share is priced right. It may be possible that the dividend yield is high and the company is financially healthy. However, we still need to check if the share is underpriced or overpriced. As a rule, we should buy when the share is underpriced. To determine if a share is underpriced, we use what is called as a price to book ratio. The price to book ratio is a ratio of the market price to the book value. So if the market price of a share is $50 and the book value of the share is $25, the price to book ratio is a 2. A share is considered to be underpriced if the price to book ratio is less than 1. However, a price to book ratio of up to 3 is considered a good buy. Let us look at this via an example. However, before we look at the example, let us look at the checklist again. We will use this checklist again to perform a first level analysis and look at the price to book ratio. If you need to know details of each of the item on the checklist, do look at episode 1. So today we will look at JP Morgan Chase, ticker symbol JPM. As of this recording, the price of the share is $199.14. So let us go through the items in the checklist. The first checklist item. As an investor, do you understand how the company makes money? Yes, I do. As an investor, I know that it is one of America's largest bank, leader in investment banking and commercial banking. So let's mark this as a yes and move to the next checklist item. The next checklist item is the dividend yield. Does the company regularly pays dividend? Yes, again, it does. And it has been paying dividend for the past many years. It has a dividend yield of 2.31% and has had a similar dividend yield for the past many years. In fact, for the past 5 years, the dividend yield has been 2.8%. For listeners, JP Morgan typically pays dividend thrice in a year in January, April, and July. However, this is just historical data, and any future dividend dates depends on the JP Morgan board. So JP Morgan board, but we as dividend investor can look at the past few years of data, and the past few years of data indicate that JP Morgan typically pays dividend in January, April, and July. Coming back to the checklist, the next checklist item is payout ratio. Now, looking at the payout ratio for JP Morgan Chase is 24.453. If I compare this with some of the other companies, including companies that we looked at the last week, the payout ratio is relatively low. However, I would want to look at it as a good sign that JP Morgan is reinvesting most of its profit in business. This also indicates that JP Morgan has a possibility of increasing the dividends in the future. Okay. Anyway, let's move ahead and look at the debt ratio. The debt ratio, again, looking up at the data, the debt ratio of JP Morgan is 1.58. That is quite good. A debt ratio of greater than 1 indicates that the assets are higher as compared to liabilities. Um, If the liabilities were higher than the assets, it would not be a good debt ratio and would mean that the liabilities are higher as compared to the assets. The last checklist item is revenue and profit. And again, depending on the past few years. Now, looking at the data for the past few years, JP Morgan has been maintaining a strong year on year revenue and growth. Now, looking at the checklist, everything seems to be in order. However, before we decide whether JP Morgan is a good price or good buy or not, we would have to look at it whether it is underpriced or not, or fairly priced. To find that out, let us determine the price to book ratio. Now, as I said earlier, to determine the price to book ratio, we need the market price first of all. And I've already said the market price is $109.14 as of this recording. Further, we need the market capitalization. The market capitalization for JP Morgan is an amazing $380.8 billion. We further need the net assets. Net assets are a total of are more than $70K million, and total outstanding shares in the market are an astounding 2.9 billion shares. So JP Morgan has 2.9 billion shares in the market capitalization of 380, net assets of $70K million. That gives us a price to book ratio of 1.44. 1.44, a price to book ratio of price 1.44 would indicate that this is a good price to book ratio, and per our recommendation is a good buy. It would have been ideal if it was closer to 1, but as I've said earlier, anything between 1 to 3 should be considered a good buy. At 1.44 price to book ratio, our recommendation is a buy. However, the final decision depends on you, the investor. So that is the episode for today. But before we conclude, let us look at the checklist again. I encourage you to use this checklist, assess shares, and most importantly, subscribe to the channel. Like the episode, provide comments so that we can provide more insightful videos to you. So until next time, thanks a lot for watching until the end, and talk to you soon. Bye.